Something unusual is happening. As of today, April 7th, 2026, gold is trading around $4,650 to $4,680 per ounce, holding relatively steady despite extreme volatility in recent weeks. But here's where it gets strange. Just a few weeks ago, gold had surged close to $5,600 levels, before dropping nearly 16% from its peak, one of the sharpest corrections in recent years. Now, in a normal market cycle, an asset that rallies this aggressively and then falls this sharply should continue to decline. Liquidity should exit, volatility should increase, and prices should search for a much lower base. But that's not happening. Instead, gold is stabilizing, holding support, absorbing selling pressure, even while interest rate expectations remain elevated. The US dollar shows strength and geopolitical risks continue to rise. This doesn't follow traditional logic, and when markets stop behaving the way they historically should, it usually means something deeper is happening beneath the surface. At first glance, this looks like just another volatile commodity cycle. But when you zoom out, this is not just about price movement. This is about behavior, because historically, gold reacts very clearly to macroeconomic forces. The International Monetary Fund and central banks have long treated gold as a function of real interest rates, inflation expectations, currency strength. And based on that model, gold should be weaker right now. Why? Because interest rates are still relatively high. Inflation, while persistent, is not accelerating uncontrollably, and liquidity conditions remain tight compared to previous years. Yet gold is not collapsing. That disconnect is the signal. Now here's where things start to shift from normal to unusual. Central banks are still buying gold, even at elevated prices. For example, recent data shows that the People's Bank of China has now increased its gold reserves for 17 consecutive months. Multiple central banks globally continue accumulating gold as part of reserve diversification. Net purchases in early 2026 remain positive, with countries like Poland and Uzbekistan continuing to add reserves. And this is critical, because central banks are not momentum traders. They don't buy because price is rising. They buy because something is shifting in the global system. Historically, when central banks increase gold reserves, it reflects concerns about currency stability, long-term inflation expectations, and reduced confidence in fiat-based systems. So while short-term traders focus on charts, institutions are focusing on structure. Now consider this. Gold recently experienced one of its most volatile phases in years. It dropped sharply, moved unpredictably, even behaved like a risk asset at times, falling alongside equities. And that's important, because gold is supposed to act as a safe haven. But during periods of extreme liquidity stress, even safe haven assets get sold, not because they are weak, but because they are liquid. This is a well-documented phenomenon in financial markets. During periods of tightening liquidity, when capital becomes scarce, investors often sell their most liquid assets first. Gold becomes a source of cash, a temporary exit. But here's the key point. After that selling phase ends, strong assets typically recover, and that's exactly what we're seeing now. Gold is stabilizing, not breaking. At the same time, the global environment is becoming more unstable. Right now, rising tensions in the Middle East are impacting oil flows, energy prices are becoming more volatile, and inflation risks are starting to reemerge. According to recent market reports, ongoing geopolitical developments, especially around critical supply routes like the Strait of Hormuz, are creating uncertainty in global markets. And historically, when energy prices rise, inflation tends to follow. And when inflation rises, gold demand increases. But here's the complication. Higher inflation also forces central banks to keep interest rates elevated, and higher interest rates usually put pressure on gold. So the market is stuck in a contradiction. Inflation supports gold, interest rates suppress gold, and yet gold is still holding its ground. So now the real question is not, why did gold fall? The real question is, why didn't it fall further? Why is support holding even after a major correction, tight monetary conditions, and global uncertainty? Because when an asset refuses to break down, it often means accumulation is happening quietly, systematically, without attention, and historically, that phase does not last forever. Because once you move beyond price and start looking at flows, supply, demand, liquidity, you begin to see a pattern forming, a pattern that suggests this is not just a recovery phase, but potentially the early stage of something much larger. In part 2, we break down the most important driver behind this shift, the structural imbalance between supply and demand, and why it may be far more powerful than anything the market is currently pricing in. If you look only at the price, you miss the real story, because what is happening right now in gold is not just about charts or resistance levels, it's about flow, capital flow, institutional flow, and more importantly, structural imbalance. As of today, April 2026, global gold markets are experiencing something that historically creates long-term trends. Demand is quietly outpacing supply. And this imbalance is not obvious at first, but once you see it, you can't ignore it. Start with the most important player in the system, central banks. Right now, central banks are still accumulating gold, even at elevated prices. For example, recent confirmed data shows that the People's Bank of China has increased gold reserves for 17 consecutive months. And China is not alone. Across emerging markets, countries are diversifying reserves, reducing exposure to the US dollar, increasing allocation to hard assets like gold. According to global estimates, central banks are expected to purchase around 800 tons of gold in 2026, which is roughly 1/4 of total annual mine supply. That's not a small number, that's structural demand. And this type of demand does not disappear when prices fall. It actually increases, because central banks operate differently. They don't chase short-term volatility. They position for long-term risk. And historically, when central bank demand rises consistently over multiple years, it creates a floor under the market. Now the question becomes, why are central banks still buying gold at these levels? The answer lies in the global financial system. Over the past decade, global debt has increased significantly. Fiat currencies have experienced long-term depreciation. Inflation cycles have become more unpredictable. Institutions like the International Monetary Fund have repeatedly highlighted concerns around sovereign debt sustainability, currency volatility, and long-term inflation risks. Gold, in this context, is not just an asset. It is a hedge against systemic risk. And more importantly, it is a neutral reserve asset. It is not tied to any single economy. It is not dependent on policy decisions. And it cannot be printed. So when central banks increase gold reserves, it often reflects a shift in confidence, not panic, but preparation. Now compare that to the supply side. Gold supply does not behave like oil or industrial commodities. You cannot suddenly increase production. Mining output is slow, highly capital intensive, and constrained by geography and regulation. Even if prices rise sharply, it can take years for supply to respond. This creates a natural imbalance, because while demand can increase quickly, supply cannot. And when demand rises faster than supply, price becomes the adjustment mechanism. Now add another layer to this system, investment demand. Beyond central banks, gold demand is also being driven by exchange-traded funds, ETFs, institutional investors, retail investors seeking protection. Recent data shows that ETF inflows have increased during volatility phases. Retail investors are stepping in during corrections. Long-term allocations to gold are rising. even after the recent drop from $5,600 levels to around $4,600. Buying interest has not disappeared. It has increased at lower levels. And this is important because when dips are bought consistently, it indicates accumulation, not distribution. Now connect this to liquidity. Liquidity is the lifeblood of financial markets. When liquidity expands, asset prices rise. When liquidity tightens, asset prices fall, but gold behaves differently. Because gold is both a hedge against liquidity expansion, inflation, and a hedge against liquidity contraction, financial stress. This creates a unique dynamic. Even when liquidity tightens, like we've seen with higher interest rates, gold may fall temporarily, but it rarely collapses if underlying demand remains strong. And right now, liquidity conditions are uncertain. The Federal Reserve has signaled that rates may remain elevated due to persistent inflation pressures, with CPI projections still above target levels. At the same time, markets are expecting eventual easing. Global growth is slowing, financial conditions remain fragile. This creates a transition phase, and gold tends to perform strongly during transitions. Now layer in geopolitical risk. As of today, tensions between the U.S., Israel, and Iran are escalating. Oil supply routes like the Strait of Hormuz are under threat. Energy prices are becoming more volatile. And this matters because energy prices directly impact inflation, and inflation directly impacts gold demand. Recent reports confirm that gold prices are stabilizing around $4,650 levels amid geopolitical uncertainty and rising oil-related inflation risks. So even if gold is not spiking immediately, the underlying pressure is building. Now combine all of this. Central banks are buying. Supply is constrained. Investors are accumulating liquidity as uncertain geopolitical risk is rising. This creates a system where downside becomes limited, not impossible, but limited, because every drop is being met with demand. And historically, when that happens, it doesn't lead to sideways markets forever. It leads to expansion. But here's the most important part. This is not driven by speculation. This is driven by structure, and structural shifts take time to fully play out. At first, they look like stability. Then, they look like resilience. And eventually, they turn into momentum. Because once demand starts to dominate supply, the next phase is not just stabilization, it's acceleration. But that acceleration doesn't happen randomly. It is triggered by macro events, triggered by policy shifts, triggered by something that forces the system to reprice. And in part 3, we break down the final layer, the macro trigger, inflation, interest rates, and the global monetary reset, and why that may determine whether gold moves slowly or suddenly. At this point, the pattern is becoming clearer. Gold is not just reacting, it is positioning. And to understand where it could go next, you have to look at the macro system that drives everything: inflation, interest rates, liquidity, and global policy decisions. Because right now, all of those forces are colliding. There's a common assumption in the market right now that inflation is under control, that the worst is over, that central banks have already done the hard work, but the data suggests something more complex. According to projections linked to the International Monetary Fund, global inflation pressures are still expected to remain elevated in 2026 in many regions, especially under current geopolitical stress scenarios. At the same time, the current energy shock is adding a new layer. Oil has surged above $110 per barrel amid geopolitical escalation, triggering fears of another inflation wave. And historically, energy shocks don't just affect oil. They ripple through the entire economy. Transport costs rise, production costs increase, consumer prices follow. This creates what economists call cost-push inflation. And in that environment, gold demand tends to increase. Now here's where things become more complicated. Central banks are trapped, because on one side, inflation pressures remain, energy prices are rising, supply chains are unstable. But on the other side, economic growth is slowing. Debt levels are high, financial systems are fragile. According to IMF projections, global growth is expected to remain around 3.3% in 2026, but with increasing downside risks due to geopolitical tensions and financial instability. This creates a policy dilemma. If central banks raise rates, they risk slowing the economy further. If they cut rates, they risk reigniting inflation. And this is what markets call a policy trap. Gold sits exactly in the middle of this conflict because high interest rates leads to negative for gold, higher opportunity cost. High inflation leads to positive for gold, store value. So when both forces exist at the same time, gold doesn't trend clearly. It stabilizes, it builds pressure, and then it moves when one side breaks. Now bring in liquidity. Liquidity is what drives large market moves. And right now, liquidity is tightening globally, but not evenly. Some economies are already showing signs of stress, others are slowing. And when that happens, central banks eventually respond. Historically, every major tightening cycle has been followed by liquidity, expansion rate cuts, or financial intervention. And when liquidity returns, gold tends to respond aggressively, because more liquidity means currency dilution, lower real yields, higher asset prices, and gold benefits from all three. Now zoom out even further. Global debt levels are at historic highs. Governments are spending more. Deficits are expanding. And this creates long-term pressure on fiat currencies. According to macro outlook reports, concern around sovereign debt sustainability could eventually weaken confidence in traditional currencies, pushing investors toward alternative stores of value like gold. This is not immediate, but it is structural, and over time, these pressures build. Now connect this back to central banks, because they are already acting. As of today, China continues to accumulate gold for the 17th consecutive month. Other emerging markets are increasing reserves. Even during price drops, accumulation has not stopped. This suggests something important. Central banks are not reacting to price. They're reacting to system risk. And when institutional behavior shifts at this level, it usually signals long-term change. Now this is where the narrative begins to evolve, because extreme price targets like $7,000 or $7,400 don't come from short-term moves. They come from macro shifts, from structural changes in the system. And for gold to move toward those levels, certain conditions would need to align, not guaranteed, but possible. Scenario 1, controlled. Upside. Inflation remains elevated but stable. Central banks gradually ease policy, demand continues steadily. In this case, gold could trend higher toward $5,500 to $6,300 range, consistent with institutional forecasts from firms like JP Morgan. Scenario 2, acceleration. Phase. If inflation reaccelerates, energy crisis deepens, central banks lose control of pricing stability, then gold could enter a momentum phase, where price is no longer driven by gradual demand, but by urgency. This is where extreme targets like $7,000 plus begin to enter the conversation, not as certainty, but as a function of system stress. Scenario 3, temporary pullback. If dollar strengthens, interest rates remain high longer, inflation stabilizes, then gold could face short-term pressure. But given current structural demand, downside may remain limited. The real shift. But here's the most important takeaway. Gold is no longer just reacting to individual factors. It is responding to a system in transition. A system where inflation is uncertain, growth is fragile, policy is constrained, and confidence is shifting. And historically, transitions like this don't stay stable for long. So now we come back to the original anomaly. Gold is holding support, even after a major correction, tight monetary conditions, rising volatility. And when an asset behaves like that, it suggests one thing: positioning. Not panic, not weakness, but positioning for what comes next. Because the next move in gold will not be decided by charts alone. It will be decided by the system, by inflation, by central banks, by liquidity, and by how the global economy responds to pressure. And if those forces align, this may not just be another rally. It may be something much bigger. What happens next may change everything.